Real estate sector, Finance Secretary, just about started blossoming. And when the real estate sector which has a multiplier effect, one would say that was there need to change the indexation rules? And again, what was the thought behind it? We just want to understand your thoughts, sir.
The thought was simplification. You see, if you try filing an income tax return and if you have capital gains, you have multiple sections of the form. There is one for things with indexation, some without indexation, some at this rate, some at that rate. This is not what I am saying. This is what we were told by industry. This is what we were told by taxpayer associations, that it's very complicated. And then indexation for each year you have to do a computation. So its a direction is simplification. Now, frankly, as a mathematical number, 20% of real and 12.5% of nominal are not very different in high return assets. Like, in fact, in most cases of real estate, we have calculated it will be beneficial, because if look, who invests in real estate? If you invest in real estate only for the sake of your own home, then you have a rollover provision which is there. You don't need to pay tax on your real estate gains. You can roll it over into another house. You can do it for values up to 10 crores. So if we are talking about individual middle class investors having a house, they don't even need to pay a tax when they sell their house, because there are rollover provisions through capital gains bonds. There are rollover provisions through buying another property. So that is not what we are talking about. We are talking about people who are looking at it as an investment. If you're looking at it as an investment, then what rate of return do you expect from real estate? I presume you are looking for something more than a fixed deposit. So if a fixed deposit is giving you 7 to 7.5%, I don't think you would buy a property for that rate of return. So you're looking at something which is substantially higher, which is 11%, 12%, 13, 14, 15, 20. Anything above approximately 10%, and if you take inflation at 4 to 5%, 12.5% is not higher than what you would get. But if you're assuming that property will grow at a very low rate, then perhaps the loss of indexation may result in a higher tax than in a 12.5% rate. But otherwise, 12.5% is far lower than 20%. Yes, there is no indexation, but it's 12.5% of a larger gain instead of 20% of a smaller gain. And we have a number of calculations. It's my rough calculation. If you have a rate of return above 10% and definitely above 11%, then you are better off with 12.5 on the nominal than on 20% on the real gain.